All right. This is the first time I'm doing something like this. This is like, I guess, a audio version of the trade plan that I put out every night, or starting to put out here on a regular basis. Especially for the new year, 2023, I want to start doing this on a more regular basis. Kind of stick to a certain format that won't be too time consuming to put out every night, and kind of give you guys the type of information you're looking for. And if there's ever any information on here that you want but it's not available, you can always reach out to me. Send me an email or send me a message on the Patreon, or send me a direct message on Twitter, and I'll go ahead and try. I can't promise you anything, but I'll definitely make an effort to make those additions. Or if there's something that you don't need on there, I can always take that out as well. But just so you know what's going on here, what this trade plan that I put out, it's basically my notes. So this is me basically interpreting the model. So the model's got a automated component. Basically takes in a bunch of data, runs a series of scripts and transformations on that data, and then generates a forecast. And then those forecasts go through another process where they're kind of filtered for what makes sense and what doesn't. And then from there, the model puts out its recommendation. And then from there, I actually go in and do a manual inspection to make sure that whatever the model generated is reasonable. And so that's kind of my notes. What you see here is essentially that manual review of the output of the model. I think that's really important. A lot of people might say, well, you should automate everything, and the computer, you should take out any human component. I don't agree with that, because I feel like I have some expertise when it comes to trading, because I've been doing that for quite some time. And I think that expertise, combined with what the model would generate, what the automation generates, is a good combination. And so far it's worked out for the last few years since I've started doing this on my own. So for December 30th, so the first part of the trade plan is basically just post-mortem analysis on what happened the day before. So if I'm just looking at the January 3rd trade plan right now that I just put out a few hours ago before the market opened. And the call for the model's output, or the model forecast, or model positioning for December 30th, which is the last day of 2022, was to be long. And it's been long, I think, for a couple of days. So it was long the 29th. We had that massive rally. It was long that whole way up. For December 30th, it wanted to be long, but if you recall, it was not as strong at all. So it was a week long. So we said a quarter of the size. So let's say we had one full unit for December 29th. On December 30th, it would have been a quarter of a unit. So let's say you had 4 contracts on long on December 29th. On December 30th, you would have had 1 contract. And so that call was pretty good. So if you call on December 30th, we had kind of a sell-off in the morning, and I think the market was down over 1%, or at least close to 1%. And then it kind of rallied all the way back up to unchanged. And then actually in the after hours, the market was up on the day. So, and when I say market, I'm talking about SPX, NASDAQ 100, the Dow 30, and then the Russell 3000, the RUT. And those are the futures contracts are ES, NQ, YM, and RTY. Those are the ones that's essentially the U.S. stock market. That's what we're that's basically what we're trading here. What the model is generating forecasts for those contracts. So we had a rally at the end of the day, pretty much closed unchanged. So one of the things that I was thinking about again, these are my notes. So one of the things that I put down was that the ideal call would have been to buy weakness, which I was thinking about putting that down on the night of the 29th when I was generating the December 30th trade plan. And I didn't do that because of the unpredictable nature of holiday trading. So there's a possibility that who knows what could happen, just because it's thin volume, thin markets. If someone needs to do something before the end of the year, they could potentially move the market pretty aggressively. And actually, we're kind of seeing that today as I record this, because if you look at the market now as on the open, when it first opened 5 o'clock Central, 6 o'clock Eastern, the market gapped up massively, and you could see the rates, the Eurodollars, or the well, not the Eurodollars anymore, but the SOFR futures, those also spiked up. So there was some kind of rate positioning that was going on. We saw that on Friday as well. There was some buying in the H6, the March 2026 of the SOFR contract, the futures contract. Some pretty aggressive buying in that contract, and actually just the reds, the greens, and the whites. There was some pretty aggressive buying. If you don't understand what I'm talking about, don't worry about it. But there was someone who needed to come in and do some stuff in rates, which might have triggered other models to do God knows what, to react to that. The fact that rates were being priced down, that might have triggered that end of day rally on Friday. Anyway, so that I thought the call was pretty good for this December 30th. So now moving on to January 3rd for today, which is actually, I should not have, what I'll have to do is change this to say January 4th, because this is for trade date January 4th. So we'll just change that, and I'll update the name of the Google Doc. So change that to 4. So one thing for January 4th, well, one thing that is interesting about the first week of the year is that it's kind of an extension of the holiday trading. So that we have a jobs number on Friday that might trigger the real beginning of the year as far as trading is concerned. I think that this short week, Tuesday, Wednesday, Thursday, might be a little, I don't know, this is kind of like meandering around, and maybe there's some movement. Maybe we get a big move one way or the other, but I wouldn't invest too heavily in a big move one way or the other, just because it's kind of an extension of the holiday trading right now. People aren't really back at their desks yet. And the beginning of the year is when people start kind of doing their accounting for traders. How much are they going to get paid out? And there's a lot of stuff that happens in the first month of the year, which can trigger volatility. Don't get me wrong, but I've seen it most of the time, and my memory is biased to the recent years where we've had pretty much very loose monetary policy, so that the standard of markets is to go up, but we could see a move down amidst a thin market. That's possible, but my bottom line here is that just tread lightly initially in the first few days of the year, and then see how the market reacts, see what the market's thinking, what it's doing, and then react to that. So that's kind of what we're doing. So the position for the model output for January 4th is to be long. So far that's correct. And we'll see what happens tomorrow. But so far on the open today, we saw a big move up. Rates kind of repriced as well. So you saw SOFR futures, those rallied. So we'll see what happens to stocks tomorrow. We'll see what happens to rates tomorrow to see if that move continues. So macro implications pointed out by the model. So we have this indicator called LI. So LI is kind of a measure. It's all the stuff that I talk about is proprietary. I'm not gonna go into details about how this stuff is calculated, but this specific indicator, I call it LI. And a lot of these symbols, a lot of these code names they're just the column of the spreadsheet that gets output from the model. So the model generates a spreadsheet. That's the one that I do the manual review on. And so this LI column is kind of like our watch out below indicator. It's when it's active, when the LI is active, that's kind of saying that you should be selling pops, right? So that price when LI becomes activated is this kind of like a magnetic price. So if the market strays away too far from that price, that's a sale, and it's like really really accurate when it comes to, pricing in a short or validating a short position. So right now the indicator, that LI indicator, sits at this value is negative 5.12. So anything below 0 means that this indicator is active. So the LS, this LS indicator, which is essentially the price component of LI, is at 0.44%. So that value, when that value goes above 2%, that's when you'll see me say, hey, we're short, and we're short aggressively in size till we get back to that magnet price, which is the price that LI was triggered at. And then every time it kind of, if the ideal scenario is that it keeps it sells off and rallies, right? Until then, when LI is deactivated, then we're like, okay, that price is invalidated now. We're not going to short rallies from that price. So that's pretty much what that first part of the document's talking about. So right now, the LS value sits at 0.44%. I want to see that go to 2%. When it goes above 2%, that's when you'll see me be short. Basically, that signal overrides any other signal in the model as far as long trades go. So if we get a long from anywhere else in the model, this will invalidate it and flip the position to short. It's not there yet, so we'll wait and see. So that's the first thing I wanted to point out. Now, as far as like this long trade, why are we in this long trade? What was it in the model? So we have a currency factor. So this AD is a currency factor. So when that's a -1, that tends to mean that the dollar index is forecast to come off. And whenever the dollar index comes off, then you get risk assets pricing higher. So that's what that AD indicator is. It's not something that we look at in isolation, right? It's just, so there's a lot of components here. So this AD factor is a currency factor. That's at -1 right now. That means that tends to mean the dollar index is susceptible to weakness. When that's the case, risk assets rally. That's number one. Number two is this AE factor. That's our commodity factor. That's set to 1. Whenever the commodity factor is a risk-on factor, when that's 1, that tends to mean, it's been 1 for a couple of days, that tends to mean that there's risk, there's people want risk in the market. They want as far as commodities go, like oil and copper and those types of things. Those things are indicating that the stock market is potentially in the short term risk-on mode, because this indicator, this commodity indicator, this commodity factor is a daily factor, right? So it can change on a daily basis. It can go to 0, it can go to -1, it can go to 2. When that happens, that's really bullish, especially for oil. And actually, we trade oil. I trade oil based on this factor in isolation. So. Well, actually, I take that back. Not in isolation. I use it in combination with a few other things. But when AE is like 1.5 or 2, I think there's a few different states. 0, there's a -1 state, a 0 state, a 1, a 1.5, and a 2. And so whenever it's like 2, for example, you'll see me loading up on oil. And I don't talk about oil here much because I have. Well, whatever. That's neither here nor there. But maybe someday I'll post oil trades as well. So anyway, so the combination of AD equals -1, currency factor is -1, signaling dollar weakness, and AE equals 1, which is a commodity factor signaling commodity bullishness. That combination, as we define it, right? So someone else could define this stuff completely differently. And this is not just looking at the dollar index and saying, oh, it's weak the past couple days, or it's not that at all. So these factors, these signals are generated, they're synthetic factors that we built, and they're generated using market data that you'll find, and we have our own way of doing transformations which yield these indications, these AD, AE, and all these other, there's another one called AF. AH is another one that we're going to talk about. So whenever AD equals -1, AE equals 1, that's suggestive of leaning long. At the very least, we can't be short. That's for sure. Whenever when those factors combine, we have a filter that says no short when those factors are combined at those values. It's not enough though. So there's if we add a few other factors, so there's BQ and BL. So basically what we're doing, what I do here is I look at these scenarios that the model identified. So one of these scenarios is AD AE combination with BQ equals -1 and BL equals -1. Those BQ at -1 means that's a volatility factor. So that's kind of saying that liquidity, it's a volatility / liquidity indicator. So when it's -1, that tends to mean that liquidity is rising. Okay, so volatility tends to fall when liquidity rises. So that's at -1. It's been -1 for a couple days. It actually flipped from 1, I think, the day before yesterday, and that kind of triggered the long, right? And then if we look at this BQ -1, which is bullish liquidity, AE equals 1, bullish commodity, AD equals -1, bearish dollar index, bearish the dollar, that tends to add to the argument for a long signal. Okay, so if we run the regression and look at the expected value of that trade using in that scenario, it's about 0.5%. And I'm sorry, it's 0.27%. And in the distribution, we're risking 0.5% to make 0.9% on a long. So that's a good risk reward ratio. The problem here is that the hit rate is actually kind of like flipping the coin. So the magnitude is definitely skewed to being long, because if we're right, we're making much more than we're risking, but the odds of us being right are about 50-50. So that's not ideal. So we say, okay, that's fine. Maybe that's not the scenario that we should base our decision on. So if we look at another scenarios, when we have these other factors, they're called CE and CI. So these are basically measurements of price. Like, is price oversold or is price overbought? So if we look at these, they're kind of not really saying much right now. CE is ideally, if we want for this long trade, we would want CE to be below -1%. So that tells me that price is undervalued by at least 1%. That's a great, that gives me more confidence to be involved in this long trade, because and that's basically it's telling me that I've got edge in this trade, right? There's other people who are potentially long from a higher price, and I'm getting longer at a lower price. I'm buying this on sale essentially, and I like that, for better or for worse, right? I'm a type of guy, like, you can talk to traders about this. Some traders will tell you price doesn't matter. You're right. They potentially could be right. I guess for me, it's more of like it's not even just a trading thing. It's like I always want to buy stuff on sale, whether it's like in trading or it's in my personal life, or I'm buying a car, or I'm buying, pomegranates or whatever. I want to buy stuff on sale. So for me, I actually have to temper my resolve in that regard, because sometimes you just have to grab stuff, right? You just got to buy it. It could be overpriced and you still got to buy it. And that happens a lot. And that's something that I've worked on as a trader, to get to the point where I can say, look, I'm not going to be able to buy everything on sale. But in this scenario, ideally, based on if we run a regression with this CE factor, the best returns are to be had when CE is less than 1%. Well, it's not there right now. It's sitting at about 0.147%, actually a little bit above fair value according to this factor. So if it was below -1%, this long would be a slam dunk, but it's not there. Okay, so we move on. So we can also look at this CI factor, which is a slower moving version of a slower moving indicator of oversold, overbought. Okay, slower moving indicator of value. And so there we can see that when we have a CI of less than 0, so there is edge, there is value in the price. We see that our expected returns are on the order of 0.5%, positive 0.5%, which is fine. Again, but in that, with the problem with that is that we're not getting the hit rate that we want. So I think it's still, I didn't write it down here, but I think it's still about a coin flip, which is not ideal. I don't want to be flipping the coin. If we add this other indicator, this BL indicator, which BL is -1, so that's like a that's also a liquidity proxy, but that's like a high frequency liquidity proxy. So that's telling me the change day over day. If there was an evident change in the way we measure liquidity, that tells me that's what that's telling me. So when it's -1, that actually tells me, believe it or not, that liquidity is the high frequency measure of liquidity is actually falling. But sometimes that's actually bullish. And the reason why that's bullish sometimes is because that is when you see these gaps in the market, okay? This stuff doesn't make sense intuitively, but you have, like, when you look at the data and you run these and you look for these factors in the market, you look to measure these things in the market, like liquidity, you'll see that sometimes liquidity reduction in liquidity is actually causes asset prices to gap. And so in our opinion, the gap would be to the upside. That's what that BL equals -1 means. And you can see that expected returns jump to 1.27%. And by the way, guys, I wrote this, you can see, I edited it now, but I wrote this before the market opened. So when I look at what the market did on the open, that verifies that my indicator actually was good. It saw this coming. So the expected return jumps to like plus 1.27%. So what's the catch? The catch is that if I look at, we run the model on some in-sample data, and then we rerun it on some out-of-sample data. So when we run it on out-of-sample, we run this scenario on some out-of-sample data, we can see that expected return actually flattens out. Basically, there's no edge in getting in the long in the out-of-sample. So that happens sometimes. Sometimes you'll see, and it's the reason why is because the out-of-sample data is a much smaller set of data. It's not going to capture the potential. It's not going to tell you the entire story. It's going to tell you, basically, it's going to tell you like what's been happening recently. And in the past, I don't know what, I got to look and see how big of our out-of-sample, or like what time horizon our out-of-sample is. But this actually did materialize in the market today. We'll see if it's going to follow through to the close tomorrow, but it did materialize. But when I wrote this, I said, okay, I can't count on this 100%. I need to put some value into it because I'm seeing this in my in-sample data. But if I can't react to this 100% confidently because I'm seeing that recently in this out-of-sample data set, I'm not seeing this materialize in the market. Okay, so we move on. So we haven't really been able to validate the long yet. Okay, well, now we can actually, because we had this separate indicator called AH. Okay, so AH is actually it's a fairly complicated indicator. So the real value of this indicator is in the parameters. So the tuning, the parameter tuning. So I don't know if you guys know much about machine learning, but you can go read about hyperparameter tuning. So what you want to do is find a certain parameter set that works for your data. Okay, so it's kind of like learning. You build a model and that model's got to learn on some data. Okay, so that's where the value of this indicator is, because we have tuned this indicator with a certain parameter set, and that parameter set persists. Like it continues to deliver to position us in the right direction. based on this indicator. And this indicator is actually it's relatively rare. It doesn't, most of the time this value is 0. Okay, but when it has several different states, one of them is this negative 200. And that happened, so on Friday's close, this AH indicator flipped to negative 200. So this is we have a well-known scenario. So as soon as it's flipped to negative 200, the model identified this scenario where AH is negative 200 and AC, which is a yield curve metric, AC is greater than 0. Well, this is a well-known scenario that should deliver us positive returns for a long trade. So in auto sample, we realized actually just on Friday, on auto sample, I realized that there was a missing that override factor I told you about earlier, where if LI, for example, LS is greater than 2%, we override all long indicators. So that was not built. That was not integrated. That wasn't a filter in the back test that we run. So once I added that filter, the hit rate was like 85%. So basically, I just added to that scenario. I added this filter to say, hey, as long as this override is off, this tell me what the results would have been in this in-sample backtest. Well, the results were great. So they're 85% hit rate for the long trade, and tail risk. The tail risk. So if you look at the distribution of the expected returns, the tail risk doesn't even exceed like 0.5%, down 0.5%. Okay, and then the expected return is about 0.57%, and the standard deviation of the expected return is literally like 1x that, which is great, right? So the ratio of return to standard deviation is like 1. I'll take that. That's good. So these are great. This validated the long for sure. And then there's another scenario that also involves this AH factor. That's our current. So if we combine AH with our currency factor, so currency factor is -1. That means bearish dollar. That tends to be bullish risk. When we combine that with AH at -200, again, and adding this GD filter, so making sure that there's no override, no short override anywhere to be found. When we do that, actually, combining AD with AH and GD greater than -1, the hit rate's 100%. So all of a sudden, there's no downside risk. Okay, now this is simulation. Right? This is not. So we have our in-sample data. We have our parameters from that. We take those parameters, we simulate, okay, and then we generate a distribution from that. Well, the hit rate, like I said, is 100%, and expected value of the trade is positive 0.83%, and the standard deviation is actually less than the expected value, so it's at 0.6%. So the simulation result tells me that there's little to no downside risk. It's almost too good to be true, which it probably is. The caveat here is that the parameters that we generate to run the simulation, those parameters were generated from a smaller sample size than I would prefer. Okay, I would like it to be larger to give us more statistical significance. But this tempers my bullishness, but it doesn't eradicate my bullishness. So it still I still, based on this combination of AH and AD, and then AH and then AC as well. So these two combinations, this number 1, number 2 in the trade plan, those two things make me want to go long. And that's essentially where our decision was today, came from these two factors, AH and AD, and actually the three, AH, AD, AC, and then GD. GD is at universal override for short. That's off, so we're good to go. Okay, so I talk about this SPY model because it's actually pretty valuable, and I'm actually been doing quite a bit more work on to get it more up to speed, to get it better integrated with our daily model. But this SPY has this factor named CM, and CM at one point last week so it's an oscillator. So at one point in that oscillator, so okay, let me step back. CM essentially was long in a long state, and then it stopped out. So it stopped out at like a pretty much like a perfect time. It stopped out and flipped short. And the reason why it did that is because the SPY model has a learning component to it. So there's it uses a machine learning algorithm to basically learn what it should expect. So when the signal is triggered, whether long or short, it basically learns from the past on what it should expect based on the characteristics of this long or short. Okay? So it's coming along, and I'm not a huge proponent actually of machine learning in trading, to be honest. I think you take a lot of risk. If you have a lot of capital to deploy, you should definitely deploy some of that capital to developing a machine learning model. Okay, but if you don't have a ton of capital, the last thing you want to do is deploy a machine learning model, because a lot of times machine learning models are unexplainable. They do stuff that you just don't understand why they did that. And if you had to answer to an investor, like I do, or someone who your wife, right, or anybody, you can't explain why a certain position cost you this X amount of dollars, that's really bad, because ultimately you're responsible for the P&L, and you're responsible above all else for that capital base, that money. Okay, you can't. It's just a matter of how much are you willing to risk, right? Like I said, if you have plenty of capital to deploy, you should absolutely deploy some of that capital into building a machine learning model, and then, that could maybe yield something really incredible that you could feed into the rest of your models, or feed into your discretionary trading or whatever kind of trading you're doing. But as a standalone piece, I don't recommend it. But we have this component. It feeds into, it is feeding into our daily model right now, and it's going to feed in. It's going to become more intertwined once we get some bugs worked out and we get some more things tuned. But that this is still short, but it's the oscillator, the CM oscillator, is about to turn back positive. So when that turns positive, it's in a negative state right now, it's when it turns positive, it's going to reset the signal. I don't know what it's going to do quite yet. Like, is it going to go flip, long, short, whatever? It kind of depends on what the market does in the next couple of days. But that's going to give us a really good indication of what the market's probably going to do in the medium term. So when I say medium term, like in the next couple weeks, right? And that would be like January. So I'm really excited to see what happens with CM from SPY in this week, because for sure this week it's going to have a transition. So I mentioned that we have this AH from SPY. So this is something else. I haven't really talked about it much. It's stalled. So when I say it's stalled, so this when I'm talking about essentially the state of the indicator. So for a little while, this AH from SPY was stalled. So it's basically increments itself on a daily basis when it wants to maintain a position, and then when it's kind of like, okay, I might be wrong about this, it's kind of stalls and stays at a flat at a certain level for multiple days, and usually that signals that the market's doing something that the model wasn't expecting, and so it's backing off, and it's gonna wait and see until conditions are restored to the point where it can more confidently theoretically add to its position. So that happened a couple of days ago, where it's back now to saying, okay, things have calmed down. I can get back with more confidence into this position. So that it's in a long state. I think it's like long state 7, which means that it's got theoretically 7 units on a long. These are not real units. These are theoretical units. Like they're kind of like levels, state levels that feed into the decision-making process. That is a good sign that we're probably going to see a short-term bounce. Okay. So that's good news for long. Just because we want to see a bounce here, because we want to see a better opportunity to sell. We want right. This is kind of the way I trade. I like I said, price matters to me. I don't want to be buying into strong rallies. Sometimes you have to, but it sucks. I don't want to do that, and I don't want to sell into the hole. Sometimes you have to, but I just don't want to do that. So everything I kind of do here is to identify points where I can get in with some edge, with some value. That's really important to me. Talk to other traders, it might not be as important. Okay. So then the final note here is this GU set its value as 1, and it's been 1 for a few days. That tends to say that there's probably some upside and maybe even some downside, but it's all going to be relatively compressed. So we're not going to see these gigantic, we could have big intraday ranges, but on a close to close basis, we're either going to be up a little bit or down a little bit. We're not going to have like massive, 2-3% up and down moves yet, right? That's what GU is saying. So this is I used to use it as an indicator to be flat, right? So it's like, okay, this is awesome. Like I don't have to make a decision today. I can just be flat. That's not the way it works anymore, because I want to be involved more and more and more in the market. Even if GU is 1, I still want to find opportunities to potentially get into to a trade. But this, like I said, when GU is 1, we tend to have very restrained the distribution, that kind of volatility or the variance in the distribution of potential returns, potential results on any given day are compressed. So you have the tails are brought in essentially. That's good because we can size up a little bit, right? Because we expect to have a smaller range and we still want to hit a certain dollar volatility target, and it's less stressful, obviously. But this is just kind of a note to say, nothing too crazy should happen tomorrow. Okay, so in summary, our position is long. We would basically use any weakness. Obviously, we didn't have any weakness on the open today. Market shot up, but use any weakness to accumulate a position. Obviously, up to your risk limit, so up to your position size. I've got my position size. I'm going to add as the market comes off, which is kind of coming off a little bit. I'll add to the position till I hit my target size. Then I'm done. Okay. So somebody asked me today about execution. That's out of scope for me at the moment with you, as far as like providing detailed execution strategy. You have to, as a trader, you have to get a feel. Execution is like, it's tough, right? My suggestion is that you trust your model. If the model wants a certain position, and we go off of settlement prices, so settle to settle, okay? So when I want to go long, I want to go long at settle or better, or meaning less. If I want to go short, I want to go short at settle or higher. So does it happen all the time? No, sometimes, but the market does give you opportunity to get better prices sometimes. Okay, so you have to kind of understand what's going on. Like what's happening in the market? What kind of news is there? Are there earnings? Are there announcements? Those things could slip your execution. So you want to minimize your slippage. Slippage kills models. Okay, it kills strategies. You can have a model that makes money, and there's a lot of them out there, but they just can't execute. Okay, and so execution traders get paid a lot of money on Wall Street and Chicago, wherever else, because they need to get the position on. And people pay a lot of money for execution algorithms and blah blah blah. So you gotta trust your model and get the trade on. Okay, if you slip a little bit on a trade, just forget about it, move on. There will be an opportunity to make it up on another trade, okay? But ultimately, your focus should not be on getting a better fill than settle. If that's your target, if you're targeting settle, don't focus on that. If it happens to be there, fill the order. But if it doesn't, you just gotta get the trade on, right? And then worry about the slippage later. Make it up somehow on another day. And the market will give you an opportunity to make it up. You just have to be patient. Okay, this went pretty long, so I gotta cut this down. This is 40 minutes. Jeez. Okay. But I hope you guys enjoyed this, or this added some context to the model, to what we put out for January 4th. It's I'm gonna change the title of the document to. I probably got to update the Patreon link too. So anyway, thanks a lot for listening. I'm not a really good camera person, or audio, talking blah blah blah. I'm not really good at that, but I guess I got to practice. I mean, something that I want to try and get better at. I guess maybe I'll get so good I'll be on CNBC or something. All right. Thanks a lot. Have a great night and great day trading tomorrow. All right. Bye.